Good morning. Welcome to ADI's weekly webinar series. My name is Uday Turaga, and I'm the founder and CEO of ADI. We, all our webinars, will start off with a very quick introduction to ADI. We'll talk a little bit about our relevant experience in this segment that we are talking about today, and then we'll share our insights and then wrap up with a roundtable discussion with a couple of our analysts. And then at the end, we'll have a short Q&A session. So today we're going to talk about how utilities and power markets are performing in the perfect storm in this crisis coming out of COVID-19, as well as the broader commodity price crash. For those of you who don't know us, ADI is a boutique consulting firm focused on oil and gas, energy and chemical markets. Most of our work is in oil and gas and chemicals, but we do serve the utilities markets quite a bit and have done a lot of projects there. And we also track the utilities market mainly because a lot of the work that we do in gas is directly tied into what's happening with power and utility markets. We work with a wide range of companies, a number of oil and gas operators, independents, chemical companies. A lot of the work that we do in power and utilities is for this segment that serves the oil and gas and energy markets with equipment and services. So a lot of the large industrials that sell gas turbines, steam turbines, and other industrial equipment into the power and utilities market, that's where most of our work in power and utilities has been focused in. And then, of course, we do a lot of work with private equity and venture capital investors, as well as early stage companies. We have been working on very interesting projects just coming out of where the general environment has been. Some of the things that we have been supporting clients has focused on helping them understand how to navigate out of the current crisis. This has included various types of analyses and projects and consulting support that we have been involved with. A significant chunk of that has focused on identifying what the customer and market landscape will look like going forward. So for clients who are trying to understand, which segments should they be focusing in, we've been doing quite a bit of work helping them understand what's going to happen in specific segments, whether it is the outlook for gas in, let's say, power generation or gas exports. A good example is LNG markets. We've been doing some work trying to understand force majeures and what that means in terms of LNG exports on a global basis. For some of the companies that are serving oil and gas operators, the shale independents are fairly distressed, and we are trying to understand which of the shale operators are more likely to survive and come out of this crisis and continue to spend capital. So understanding the customer landscape and the market landscape is something that we have been working on. A couple of other areas where we are supporting clients right now is focused on helping them understand what their offering mix needs to look like, whether it's product mix, service mix, and what does the value proposition for those offerings look like as they get ready for the new normal or some sort of a recovery coming out of this crisis. Clearly, there's been a lot of interest in looking at benchmarking costs and finding ways to cut them in order to improve competitiveness. The private equity and the broader investor landscape has been very active. Currently, we're working on a project with a private equity firm, helping them with due diligence as they look at transactions. In general, valuations have gotten attractive in the current situation because the market landscape going forward is fairly bleak, and that has a big impact on growth prospects for companies. And so private equity firms have been fairly active looking at opportunities. So those are some examples in which examples of how we have been supporting clients in this environment. Of course, reach out to us if we can be of help. Talking specifically about utilities and power markets, we have some examples of projects that we have helped clients with. One was an OEM selling catalytic environmental systems. We help them understand the market size and growth outlook, in particular for these environmental systems in coal and gas-fired power plants. We earlier in the year, we completed a project and then did a refresh of that just a couple of weeks back, looking at the outlook for gas turbines and steam turbines for one of the large diversified industrials. Energy storage in general, we are seeing a lot of activity there, and I've spent quite a bit of time looking at various energy storage technologies and supported an early stage venture-backed startup company recently that had developed a battery-based remote power offering, and we helped them define a sales and marketing strategy, looking at all potential customers, segmenting them by various criteria that would be best served by the value proposition of this particular startup. We have supported some of the E&P independents, look at what the outlook for gas-fired power looks like, especially in select markets that are likely to be stressed going forward. And then finally, we have been doing a lot of work in general for the US Department of Energy. We've done quite a bit of work in the past, helping them benchmark costs and economics of various renewable energy technologies, as well as finding ways to improve the competitiveness of some of these renewable power technologies. And as we speak, we are working on a project focused on helping the DOE understand new markets for small-scale LNG, also a lot of which tends to get used in the remote power, backup power market. If you haven't been following some of our work, we've been publishing a lot in general, coming out of this crisis, looking at various aspects of the energy industry. You can go take a look at our website and you can see some of this research on our page specifically focused on COVID-19. All the recordings of our past webinars, as well as the decks that we shared during these webinars, are also available to be downloaded at the website, so that all of those resources are available. And then, of course, if you're interested in ongoing coverage at a more granular level in terms of understanding what's happening in this market, and this is a particularly dynamic market with a lot of changes happening across multiple segments, feel free to reach out to us. We are offering a new research service that's focused on regular, ongoing, frequent updates in terms of understanding the various aspects of this market. So let's get started. I'll be joined here today by a couple of my colleagues. Swati Singh is an analyst with ADI. She leads a lot of our research offerings work. And then Brandon Johnson is one of my senior colleagues. Brandon is a project manager and supports various projects. He usually leads our consulting projects, but also supports some of the research work. He has been very active in general with a lot of our utilities and power projects. So let's get started here. I mean, clearly, given the environment we are in, we expect some sort of a decline in electricity demand. In general, if you compare electricity demand on a monthly basis, which is the chart on the left, we are about 25% lower than where we were 6 months back in September, October. But on a yearly basis, but there's quite a bit of seasonality in power markets, as you can expect. And if you compare power demand today relative to the same time frame a year back, that's about 5% lower. And the chart on the right just shows that on a normalized basis, this is percentage change in electricity demand relative to where we were in September 2019, and that shows that 25%, almost 25% dip relative to where we were 6 months back. If you look at the broad mix going forward, in general, we expect overall electricity demand to decline by about 3% or so in 2020 relative to where we were in 2019. But in general, if you look at the trend more broadly, you'll see that electricity demand has been fairly flat over the last few years or so. So coming off of a flat outlook for electricity demand, a 3% decline is a fairly substantive impact that the industry, that the utilities market will have to bear this year and potentially going forward. Clearly, because of the lockdowns, residential demand has picked up, and utilities that have a significant presence or have a higher exposure to residential markets are better positioned in this environment. We have a selection of companies active in the utilities and power markets here, and a lot of the players who have good exposure into residential markets are reporting an uptake in residential sales. Um, the exposure of some of these markets to some of the other end-use segments, whether it's say transmission or commercial and industrial markets, is clearly very important, because that each of these markets price electricity, and the contractual terms for electricity sales into each of these end-use markets varies widely. So if you take a look at PPL, for example, they have a significant presence in the transmission side of the market as well. And a lot of the transmission markets have rates that are set using formulas under the FERC jurisdiction. So a lot of those rates are not necessarily exposed to the demand-related trends that we are seeing right now. So that gives some more protection to some of these utility players. But more broadly, in general, we are seeing residential increases range anywhere from 4 to 7%, as Exelon is reporting. And we'll talk a little bit more about this going forward. On the other hand, utilities that are predominantly known for serving commercial and industrial markets, that have a strong exposure to commercial and industrial end-use segments, are clearly struggling in this environment. Evergy, for example, is reporting a 13 to 15% reduction in sales to commercial and industrial customers, while this can be significantly higher. So DTE Energy, for example, which serves to a large extent the Michigan market, which accounts for the largest portion of their demand. Residential and commercial and industrial load declined by 15 to 20% for commercial, and as much as 40 to 45% for industrial loads. So that's a pretty significant impact for DTE on the commercial and industrial side going forward. So if we tally up on a representative basis some of these changes in load profiles across the various end-use segments, we are showing that on this page here. On the left is the change in residential sales. You can see that on average, residential sales have picked up by 5% or so. Clearly in some, for some utilities, that number is much higher. But on average, across the board, I think a 5% uptick in residential sales is a reasonable expectation. On the commercial and industrial side, we think that an average of 14% is what we are seeing across some of the industrial, some of the major utilities. Clearly, for some companies, it's much higher. DTE is a case in point. But I think going forward, I think roughly a 15% decline in commercial and industrial sales is a reasonable expectation. But this doesn't necessarily translate into corresponding declines in margins for utilities, mainly because residential is a much more profitable business relative to, let's say, commercial and industrial. The typical margin on residential sales is 40% or so. This is an average representative estimate. It clearly varies from player to player, but on average, it's about 40%. And for commercial and industrial end-use markets, it's about 30%. So the uptick that you see here is going to offset to a certain extent the decline that you're seeing in commercial and residential markets. Transmission markets also have a similar margin profile as commercial and industrial markets at about 30% or so. But this margin is independent of volume. So it doesn't really matter that the overall demand profile is declining. A lot of this margin is going to be protected for utilities going forward. Clearly, this is going to have a pretty big impact on capital spending. In general, the industry has enjoyed or has invested steadily over the years at a steady rate. We have seen capital spending grow. But going forward, we expect some sort of a decline in capital spending. It is possible that we might still see some sort of an uptick in capital spending depending on what the rest of the year looks like and what kind of changes occur to demand profiles. But I think that's a fairly optimistic scenario. In general, we should expect a decline in capital spending in 2020. But more significantly, we expect this decline in capital spending to kind of spill over into 2021. In fact, we have greater certainty around the decline in capital spending for 2021, primarily because a lot of the challenges that we see in the market today will have to be passed on to customers or will lead to revised utilities and rate-making processes with regulators for next year, and that will limit the amount of capital utilities will have to invest in terms of capital spending. So collectively, if you think about strategic implications for the utilities market based on where we are today, clearly the load declines that we see right now will have an impact on sales and revenues, primarily coming from lower commercial and industrial sales. This will have an impact on the profitability of some of these players. But more importantly, there are knock-on effects to this. We are also headed into some sort of a difficult economic environment. It's too early to say whether we are looking at a prolonged recession or not, but we are looking at fairly recession-like conditions for the rest of the year. And that is going to have an impact on how much disposable income is available for people. And because of that, we might see challenges associated with collectibles and other delays in terms of payments. And that will collectively further accentuate the impact utilities will face from the load declines that we are seeing right now. Utilities are hoping that some of these losses from demand profile changes can be passed on to customers, and they should be able to adjust their rates for next year. But I think that expectation or planning according to that expectation is a risky approach. Our analysis shows that rate makers and regulators in general are fairly reluctant to pass on all of these losses on to customers and consumers. And utilities should expect some resistance that they will face during the rate making process next year from regulators. In general, if you go and talk to the utilities, they'll tell you that they haven't made big changes to their capital spending outlook for 2020. But from a practical point of view, just given social distancing and related regulations that are coming out from the US CDC, we anticipate some impact on capital spending for the rest of the year. We don't think that EPC firms or other contractors will be able to accomplish the capital spending plans that a lot of utilities have, and collectively that might lead to lower capital spending than budgeted for the rest of the year. Of course, the same social distancing factors will have an impact on O&M, operational and maintenance programs, and that could potentially lead to a pretty significant backlog on both the capital spending side from a capital projects point of view, as well as from a maintenance point of view into the fourth quarter. And that could potentially lead to a significant uptick in skilled labor rates, EPC billable rates, because there's a lot of work that will need to be accomplished all at the same time. So collectively, I think utilities are going to have a fairly difficult year in 2020, but we expect some of these challenges to spill well over through the end of 2021. And this is mainly because of the nature of the utilities market. A lot of pricing for electricity sales is usually set, especially for regulated markets, through rate-making processes a year in advance. The stress that utilities will face this year will translate into more difficult rate outlooks going forward, collectively making 2021 a challenging year as well. So with that, let us bring our colleagues in here and have a short discussion. We have a few questions here that we've been hearing from our clients and other stakeholders within the industry. So we'll talk about these a little bit at our end. In the meantime, if you have questions, please put them in the chat box, and we'll be happy to address them as we go along. With that, let's talk a little bit about operational disruptions that utilities are facing. Brandon, you've clearly been spending some time in the utilities market. Can you talk a little bit about what operational challenges are you seeing in utilities today?
Yeah, so utilities aren't just being impacted in terms of a decline in demand, but there are also some operational and supply chain issues as well. We're seeing issues around the availability of parts and equipment and the delayment of maintenance due to some social distancing guidelines. And this will eventually lead to maintenance and infrastructure development challenges going forward, especially if you look at renewable projects, where some of the developers have experienced difficulties in getting critical equipment or critical components, such as the photovoltaic cells and turbines. And this is leading to some project delays.
Okay. And is most of them related to the broader vendor base in terms of the supply chain, or do you see other challenges as well?
Mostly related to the supply chain in terms of getting parts and equipment, especially if the vendors were overseas, especially from Asia. They were experiencing some delays.
Okay. Swati, coming to you, clearly if you look at what's happening to oil and gas, oil markets in particular, not so much gas, but oil, as demand has fallen, we have seen clearly a pretty big impact on oil price, well beyond the price changes that we saw coming out of the OPEC plus issues early March. Clearly, electricity markets are oversupplied as well, right? Because of a significant decline in demand. Will that mean we're going to see lower electricity prices? You are muted. Let me unmute you. Yeah.
Yeah, so I was saying that the reduced electricity demand usually tends to lower the wholesale electricity prices in the near term. However, the electricity prices are really set to a larger extent by the annual rate making exercise. So consumers may not be able to see the lower electricity prices in the near term because of these timelines of electricity rate regulations by states. Even though we see a significant demand, a significant fall in demand, so that may not translate into the price decline in the near term. But on the flip side, in some of the deregulated markets, we might see some reductions, but that will be very limited.
Okay. Okay. Brandon, we've been spending quite a bit of time looking at coal-fired power plant retirements and the general displacement from gas-fired power. How is coal-fired power faring in the current crisis?
Yes, so typically when electricity demand declines, the most expensive electricity to produce is taken offline and being produced, and that is coal. So as you stated, coal-fired power has already been experiencing a decline due to the cost competitiveness of natural gas and renewables. But now there's also some supply issues with coal, as some producers have shut down mines for a month, while others have yet to set a reopening date. And this will cause a steeper decline in the role of coal going forward than most have anticipated.
Okay. So coming over to the natural gas side, Swati, what does all of this mean? I mean, the utilities are clearly struggling a little bit, right? I mean, the entire value chain is struggling, of course. But what does that mean in terms of natural gas and what's happening to the utilities landscape, just given that a lot of gas tends to end up in the utilities market?
Well, we saw oil prices falling, and conceptually, we're expecting the same for the natural gas. Now, the significant chunk of US natural gas consumption goes to, as you mentioned, power generation and industrial, which represents approximately 40% and 30% of the total gas delivered to the customers. As these lockdowns have kicked in the normal weather, this will have less impact in the near term for power generation. However, the fact that a big chunk also goes to the industrial sector, and that segment is actually struggling, so it's likely that natural gas and utilities will also get hit over the time.
So finally, coming to this question around energy transition, Brandon, what is the, I guess, latest thinking in terms of how COVID is going to impact the energy transition?
So yeah, COVID has been accelerating plans to transition from coal-fired power to natural gas or renewables, especially since electricity demand is falling. The thought process behind that is, simply, why many utilities feel why keep a plant up running if they plan on closing it within the next year or so, especially when the economics aren't favorable. And there's also talks about an infrastructure stimulus bill, which will likely aid the acceleration of renewables, as government funding will probably favor renewable infrastructure.
Okay.
And even this year, we've seen a drastic increase in renewables in the energy mix.
Okay, excellent. Well, if there are any questions, we'd be happy to take them at this point of time. Just put them in the chat box. Happy to address that. And finally, just as a recap, if there's interest in understanding some of these trends on a more granular basis with quantitative insights and data, please reach out to us. We're offering a new service that provides weekly updates, and we'll happy to discuss a little bit more about some of this. And then finally, we're continuing our weekly webinar series. This was the first tranche of 5 or 6 webinars that we've had over the past few weeks. We intend to continue this. And going forward, we are taking a deeper look into some of the other segments within the oil and gas industry. Next week, we'll talk a little bit about industrials. Our firm does a lot of work with industrials and OEMs, and we'll share some thoughts on how that segment is getting impacted and options there for responding to this challenge. The following week, we'll talk about EPCs. We'll again look at that in a similar sense. Early June, we'll talk about the new normal. What will that look like? What segments are likely to recover faster than others? We've been doing a lot of client work there, trying to understand which segments are going to see a recovery first, and how can companies prepare for those segments. And then we'll take a look at renewable and low carbon power markets on June 11th, and then mid-June we'll talk about the oil field services markets. Our intent is to continue these weekly webinar series, and we have more topics coming up. We'd welcome input and feedback on what's working in these webinars, what can get better, and potential topics that you'd like to be interested in. So with that, I'd like to bring today's webinar to a close. Thank you for joining us, and see you next Thursday at 11 a.m. Central again. Thank you.
Thank you.